Broad market indexes for technology, NASDAQ exchange is up nicely. The only thing that's not up quite as much as the European, understandable with what's going on in Europe. And by the way, if you're wondering how were bonds doing during this, bonds did very nicely as well. Now let me ask you something. This is an axiom in the investment business. If I say high return, you should expect high risk. If I say low return, you should expect low risk. And if I say low risk and high return, you should not take my business card. That does not happen. Risk and return sometimes have trial separations, but they don't get divorced. Okay? Look at this chart and tell me which one of those charts in the equity side has the most risk. Which one would you think? Emerging markets. Which one had the most return? Emerging markets. And straight on down the list, there was a very linear relationship between risk and return in 2010, even with all those speed bumps. And bonds the same way. Junk bonds, euphemistically called junk bonds, lower rated bonds, have the highest return. And then you work all your way down to the treasuries in the municipal market, and they had your lowest rates of return. So we've regained some confidence in 2010. Maybe we got the gearbox into second, or perhaps even third gear. So more risk, more return. It wasn't just by markets. You could look within markets and get even more granular. If you invested in small stocks or medium-sized stocks, they did better than big stocks. Emerging markets did better than developed non-U.S. markets. The more economically sensitive sectors, consumer discretionary stocks, the washing machine makers, the dryer makers, the refrigerator makers, the car makers, they were doing very well. So the more risk you took in sectors, the better the returns. And clearly high-yield bonds with the best returns. So risk and return were nicely married. Now, I've been working for M&I for a while, in the investment business for a long time. I missed a whole bunch of Botox treatments. But basically here, in my business, I kind of walk the plank every year. At the end of the year, I do these forecasts for the next year, and the next time, the next year, and so forth. So I'll show you very quickly how we did on our scorecard for our organization. And I started doing this for M&I and joined in 2008. And I wouldn't show you the scorecard unless...
Good.
Right. Right. I remember I had a few cards under the mattress when I was... Okay. So, big thing we got right was we didn't think the economy would go back into a double-dip recession. While that sounds easy now in hindsight, over half these people in the investment strategy business got this one wrong. They thought we would slip back and probably were too conservative with their investments in that environment. We thought there would be uneven global growth, which we're going to talk some more about here. And I'm not going to go through all the way through these. These are the big ones. We got most of them right. We don't know how the stimulus is going to play out yet in terms of inflation, but we're concerned about it. And then in the equity area, the big thing we got right was higher risk. We really like small caps. We really like emerging markets. So that if you were structuring a portfolio, we were leaning in that direction. We like growth stocks more and so forth. So we did okay. We didn't do as well in the fixed income arena. We thought interest rates would come up. They didn't start to come up until the very end of the year, so we got this one wrong. They had to come up significantly in 2011, but we definitely got that one wrong in our forecast for 2010. So now the question is, after all of this stuff that we have been through, now the question is what's ahead? And we think it'll be a year of expansion, basically. 2011, we think, has a real opportunity to give us some good things, but it's going to be critical that we straddle this growth divide. And there are lots of divisions around the globe in terms of economic performance and economic policy. These divisions are really significant challenges to 2011. The biggest growth divide of all, and kind of the one that creates all the other subsequent subdivisions, is economic growth, or what we call GDP, gross domestic product. Better back up, I feel like I'm going to fall right into this. This is really the critical one because everything else drives from this. These are it's kind of what we call underachievers. These are not regions or countries not growing very fast. 1%, 2%, 3% growth rate for the next 2 or 3 years. It's not our forecast, it's the International Monetary Fund. And you can see how tepid those growth rates are in the Eurozone, in the U.S., in Japan. Now, we happen to think the U.S., unlike the IMF forecast for M&I, we have the U.S. growing between 375 and 425. Not 2.5 to 3, where most people are. We have a much more optimistic view on the U.S. performance. But having said that, then on the other side, look at these forecasts. China, Brazil, India, they're all looking to grow their economies at 8, 9, 10%. Well, guess what an economy worries about that's growing too fast? What's one of their major concerns? Inflation. So how do you control inflation? You're worried about inflation because your growth rate is so fast that you're worried that prices are going to start to increase. So how do you slow that down? Instead of keeping interest rates low, what do? You raise them. People on the left are going to keep interest rates low. They're still in the boat going, whoa, we've got to keep this money cheap. The other people are now saying, we've got to make money expensive. They're pushing the other way. So the interest rate divide, as a result of growth differences, GDP divide, creates an interest rate divide. So here you have these countries that are keeping interest rates very low. Let's keep capital cheap. We want you to borrow. We want you to invest. We want you to borrow. We want you to spend. That's what we want you to do in those economies. In these economies, we're worried that that's happening too fast, so we start raising rates, and it's already happening. China has raised rates 3 times in less than 60 days. China has raised reserve requirements on their bank 6 times in 60 days. And reserve requirements in China, by the way, for their banks in this country, if you have $1 million in deposits, you keep about 10% of that in reserves in this country. Okay, everybody with me there? In China, for every $1 million in deposits, they keep 20 in reserves. Okay, they keep twice as much in reserves. Everybody says China's banking system, it's actually got more conservative loan to deposit ratios or loans to reserve ratios than we do in the United States. So interest rates going up. So now we have countries growing faster, raising interest rates, countries growing slower, keeping interest rates cheap. That's going to be another divide here that comes is currencies. The US dollar, which has been weak, moved nicely up when things were getting bad, and everybody raced to the dollar and wanted the dollar. Now everybody's running the other way. We printed so much money and made money so cheap that people are sort of getting scared of owning the US dollar. Okay, that's another consequence of growth rates being low, because if you keep your currency weak, guess what will happen to your exports? They'll go up. And we would like to get our exports up. So there's some real fringe benefits to having the dollar be cheap. May not be his principal objective, but there are some real implications for that. You look at China's, which is sort of this, I don't know if this will show up or not. Here's China's line right here. Their currency has been appreciating, and we're mad. So we're pointing fingers at China saying, your currency's unfairly cheap and you should let it appreciate. And they're pointing their finger at us instead of saying, you've made yours really cheap to help your exports, which is hurting us. So now we have this war going back and forth and finger pointing going back and forth over the differences in currency. Okay, so that's another divide. And there are lots of these divides around. There's deflation versus inflation. Bernanke's still concerned that we're going to slip back into deflation. And if you read his statement from just 2 weeks ago when he gave a speech at the press club in Washington, D.C., he still says we haven't got enough economic traction. We need more inflation. He wants more inflation. He's laid the seeds to get a really big harvest of inflation. Okay? It hasn't happened yet, and he says he can stop it. But I remember, I'm old enough to remember, in 1972, we had very modest inflation in 1972. It was about 5%, not great. I mean, we don't think of that as a great inflation number now. But in 1973 and 74, we went from 5% to 12% inflation in nothing flat. And it took us 6 more years to get inflation under control, and a gentleman by the name of Paul Volcker, who took interest rates sky high in this country to break the inflationary cycle. I was a supervisor of some research analysts at that time. I had to fill out federal forms for their salary increases. We had wage and price controls. And I had to fill out a federal form saying I was giving somebody within the federal limits of less than an 8% salary increase. Draconian. Today we kill for an 8% salary increase. Okay. On the right-hand side, here's inflation in these emerging markets. China's at 5, probably really closer to 10. They don't measure it the same way we do. If we did it on a comparable basis, their inflation number would probably be higher. And food inflation really hurts the Chinese consumer, particularly the one in the rural area that doesn't make much income and spends most of their income on food and shelter. So it's really harsh stuff in China when that hits the rural sector. And there are other divides. Trade, tax, stimulus, austerity, all of this stuff. You read about it every day. Every paper you pick up with a good business section will have a story that will relate to these. We'll have trade wars. We'll have talk about tariffs and protectionism and capital controls and currency wars and interest rate differences. And you'll read all about it, and they all stem from the growth divide and economic output. Every single one of them. We get our exports accelerating, and people are going to scream bloody murder about that. We'll be screaming bloody murder that China's trying to control their